Welcome to the Deep Dive. Today we're going way back, digging into the early thoughts of a real investing legend.
Yeah, we've got excerpts from Warren Buffett's 1959 partnership letter. It's, a fantastic window into his thinking relatively early on.
So our mission for this deep dive is pretty clear.
Mm-hmm.
Let's unpack this letter. What was he seeing in the market? How did his partnerships actually do? And what was the strategy back then in 1959?
Right. Let's set the scene. It's 1959. The market, well, it looks strong on the surface.
Exactly. The big number everyone saw was the Dow Jones Industrial Average. It jumped from 583 to 679. That's, what, a 16.4% gain?
Mm-hmm. And if you add in the dividends, the total return was almost 20%. 19.9% to be precise. That sounds like a fantastic year, no question.
It really does. But here's the first big takeaway from Buffett's letter, and it's pretty crucial for understanding how he thought. You can't just trust that headline number.
Definitely not. Because even with the Dow soaring, if you looked at the actual New York Stock Exchange, more stocks went down than went up that year.
Yeah, the numbers were 710 decliners versus only 628 advancers. That's quite a split, isn't it?
That really is. It shows that, the rising tide wasn't lifting every boat. And he also points out other major averages, like the railroad average and the utility average, they actually fell in 59.
So the picture was much more mixed, much more complex than just looking at the DJIA.
Which leads to the next question. How did the big established players do in that kind of environment? Buffett actually compares his results to a couple of giants.
Right. First, Tricontinental Corp. They were the biggest closed-end fund then. Huge assets, like $400 million, their overall gain, about 5.7%.
Only 5.7%. Wow. And the other one?
Massachusetts Investors Trust, MIT. Biggest mutual fund, even bigger assets, $1.5 billion. They did a bit better, maybe 9% gain overall.
Okay, so 5.7% and 9%. Compare that to the Dow's almost 20%. Clearly, those big managers were finding it tougher going.
And there's this great quote in the letter from Fred Brown, who was president of Tricontinental. He basically said that markets driven by sentiment, by enthusiasm, which 1959 seemed to have elements of, well, they were tricky for value guys like them.
He even joked about needing space boots.
Yeah, space boots.
Yeah.
It perfectly captures that feeling, right? Like things are detached from reality, from fundamental value.
It really does. And it connects directly to what Buffett himself says in the letter. He explicitly states he'd been very apprehensive about general stock market levels for several years already.
Apprehensive even with the Dow rising. Why?
He thought that even the blue chip stocks, the supposedly safe ones, their prices had a substantial speculative component.
Meaning hype. People just bidding them up beyond their real worth.
Pretty much. Driven by optimism, not just business value. And for Buffett, that spelled risk. A real risk of loss.
So he was already wary of this idea that, oh, it's a new era, things are different now, valuation doesn't matter.
Exactly. He flat out rejects that. He says he doesn't buy the idea that trees really do grow to the sky. The old standards, for him, still applied.
Which leads to his core principle here.
Yeah.
Caution first. He says he'd rather sustain the penalties resulting from over-conservatism than make a big mistake and suffer a permanent capital loss.
That focus on avoiding the big unrecoverable loss, it's right there so early on. Fascinating.
Okay, so that's the market. Kind of weird, maybe a bit frothy. Buffett's feeling cautious. Given all that, how did his partnerships actually perform in 1959?
Well, based on his previous letters, you might expect a bit of a, let's say, muted performance. He'd always said expect good results in down markets, but maybe unimpressive ones when the market's rapidly rising, like the DJIA did in 59.
Right, that was his standard pitch. So you'd think 59 wouldn't be their best year relative to the index.
But surprise, the letter shows the 6 partnerships that ran the full year had overall net gains between 22.3% and 30.0%.
Well, wait, 22.3% to 30%?
Yeah, the average gain was about 25.9%.
Okay, let's put that in context. The big funds were at 5.7% and 9%. The Dow Jones total return was 19.9%, and Buffett's partnerships averaged nearly 26%.
Exactly. Significantly better. So much for unimpressive in a rising market, at least this rising market. It seems his approach worked really well that year, despite the challenges for value investors.
How was that calculated again? It wasn't just realized profits, right?
No, it's based on the change in liquidating value. So basically what all the assets were worth at the end of the year compared to the start, after accounting for partner money coming in or going out, it's about the change in market value of what they owned.
Got it. And that's before his cut in interest to partners, but after operating expenses.
Correct. And he even mentions one specific expense, the Nebraska intangibles tax. Apparently it kicked in properly for the first time that year and shaved off about 0.4% from their results.
Just a small detail, but it shows how meticulously he tracked things.
Absolutely. So the big question then is, how? How did he pull off that kind of outperformance in a market he found kind of tricky? Let's look at the portfolio strategy.
Okay. He says the portfolio at the end of 59 was roughly in two parts.
And one part was, well, it was significant, a single large investment. He mentioned it being 25% of assets the year before, but by the end of 59, it was up to about 35%.
35% in one stock. He even calls that unusually large.
He does. But he gives strong reasons. First, the company itself was partly an investment trust. It owned like 30 or 40 other high-quality stocks.
Okay, so diversification within the holding itself.
Right. But here's the key value insight. They bought it and were still carrying it at a substantial discount from asset value.
Meaning the market price of the shares they held was way less than the actual value of all the stuff that the company owned, buying dollars for, say, 60 cents.
Something like that. A significant discount. Plus, they weren't just small investors. They were the largest stockholder by a good margin.
And he mentions the other big holders were on the same page.
Yeah, agreed with their ideas. So they had influence. It wasn't just passive.
So because of that discount, the quality, their influence, he was pretty confident.
Very. He says the probability was extremely high that this one investment would beat the market until they sold it. He was actually hoping that would happen sometime in 1960.
Okay, that's the big 35% chunk. What about the other 65%?
That was spread across securities he considered undervalued, just generally cheap stocks, and also these things called workout operations.
The workouts.
Yeah.
What exactly are those?
Think special situations. Things like mergers, liquidations, spin-offs, reorganizations. The key is the profit from these depends more on the specific corporate event happening successfully, not so much on which way the general stock market is heading.
Ah, so it's another way to get that insulation from the market he talks about.
Precisely. Which brings us back to his core policy, which he states again very clearly. Try to invest in situations at least partially insulated from the behavior of the general market.
And partially insulated really means finding value tied to something specific, right?
Yeah.
Like that big discount to assets or a merger completing, not just riding the market wave.
Exactly. Value that isn't just based on overall market sentiment or the economy doing well.
And he figured this approach should give them better results when the market tanks.
Right. The insulation protects you on the downside.
And maybe just average results when the market booms.
That was the theory. Although, as we saw, 1959 turned out much better than average for him.
And it's interesting, he adds a little note near the end. He says that prediction about average performance in bull markets might get tested pretty soon in 1960.
Yeah, because by February 1960, when he was writing the letter, the Dow had already dropped quite a bit, erasing more than half of its 1959 gain.
So the market volatility he was wary of was already showing up.
Seems like his apprehension was well-founded.
Okay, let's pull this all together. What are the big insights, the kind of enduring lessons from this 1959 snapshot?
Well, first, definitely that headline market indices, like the Dow, can be really misleading. You absolutely have to look underneath.
Yeah, a rising average doesn't mean all is well everywhere. Second, markets driven by hype and sentiment. They're tough for value investors. You might need those base boots.
Right. Third, Buffett's early strategy was all about finding value that was somewhat disconnected from the market's daily whims. Deep discounts, workouts. That insulation was key.
And that allowed for potential outperformance even when the overall market setup didn't seem ideal for a value approach. And fourth, that big concentrated bet wasn't some wild gamble. It was a calculated move based on a massive discount and having some influence.
That high-conviction, concentrated investing was already part of his DNA.
So thinking about today, how does this stuff from, over 60 years ago still apply? Does it resonate for you listening now? How much do you look past the S&P 500 headlines?
Yeah, if the averages aren't the full picture and sentiment can push prices all over the place, how do you actually define success for your own investments?
And maybe more importantly, how insulated are your own holdings from just the noise, the day-to-day swings of the wider market? Something to chew